Do some multiple choice questions on financial statements of limited companies. These are also taken from past, and we'll start with the March 2016 paper 1-2, question 17. A limited company intends to issue shares at a price above the nominal value. Nominal value can also sometimes be referred to as par value, so if you see that term, it means the same thing. Remember also that when you issue shares at a price above the par or nominal value, this extra amount is what would go to the share premium account. Which items, apart from the bank balance, will be affected by the share issue? Well, if you have a look at this, your nominal value will go to the share capital account, and then, as I've just mentioned, any extra amount above the nominal value is going to be share premium, which is going to be a capital reserve, compared to a revenue reserve, which refers to things like retained earnings, etc., that you can actually distribute as dividends. Share premium you can't distribute, and that's why it's known as a capital or long-term reserve. So therefore, we like answer B, share capital and capital reserves. That's what our choice will be. The next is question 18. A company issues 1 million ordinary shares of $1 each at $1.30 per share. It also issues a debenture for $500,000. So what has happened is you've got $1 million, or 1 million shares times that $1 will go into the share capital account. And the difference between these two, because they were issued at 130, so the difference of 30 cents would need to go to share premium. The debenture of $500,000, you need to keep in mind, is a non-current liability. It's not actually part of equity at all. So the question asks, what is the increase in the equity of the company? And for this purpose, we're actually going to ignore the debenture completely because it's not part of the equity. However, both our share capital and our premium are part of equity. So in fact, we'll use the full $1.30 and we get 1,300,000 as our answer, and we will therefore select B. Looking at Cambridge, June 2016, paper 1-1, a company has a bank balance of $20,000. The company's equity and reserves are shown. So here you can see they've given you some figures. Ordinary shares at 50 cents each, worth $10,000. So you could actually work out then that, in fact, you've got 20,000 shares simply by comparing this dollar value to the price of each share. Capital reserves means your things like your share premium, etc., 5,000. And then your revenue reserves will be your retained earnings and so on, 3,000. The debtors wish to pay the maximum dividend possible, and how much of the bank balance will be used to pay the dividend. We obviously need to check how much cash we've got. We've got $20,000, so that is quite a lot. Obviously, you can't really pay out more than the cash that you have, so you need to keep that in the back of your mind. But now you need to have a look at these, and of these, it's only revenue reserves that is actually distributable as a dividend. You cannot distribute your capital reserves nor your actual share capital. So the maximum that you would actually be able to pay out will be that $3,000. If your bank balance was only $2,000 instead of $20,000, then you would only be able to pay $2,000 of that, because that would be the cash that you've got. But fortunately, you have lots of cash available, so you can pay out the full amount of revenue reserves, $3,000. If you look at the options available, that means you will choose A. Question 18. Which statements about rights issues is true? What a rights issue is, it's a normal share issue, but the shares are only issued to existing shareholders. You might want to do this where you issue to existing shareholders before others, so that you keep control in the company and you're not spreading that control among other shareholders. So you need to have a look at all the options over here. Shares can be sold to anyone would only apply to a public company that's issuing general shares, not just a rights issue. So we do like the answer B. Shares can only be offered to existing shareholders. But let's just check the others over here. Shares cannot be sold at a premium and cannot be sold at less than market price. That's irrelevant. Both of those are actually incorrect, because if you have a rights issue, you can issue it at any price you want to, but it's just that you have to issue it to the existing shareholders first. We would therefore choose B as our answer. Number 19. A limited company's financial statements contain the following items: bonus issue, debenture interest, profit and for the year, and profit on disposal of non-current assets. The question then asks you which items would be found in the statement of changes in equity. In other words, any equity accounts need to be shown in the statement, and so as soon as any of these is part of equity, we would show it in the statement. So let's look at them one by one. The first one, the bonus issue of ordinary shares, this would be shown as a drop in your revenue reserves and an increase in share capital. Because remember, a bonus issue is sort of like in place of a dividend. So instead of the existing shareholders having to pay for new shares, as is with a rights issue, a bonus issue means they are simply getting extra shares as a bonus in lieu of dividends usually. So a bonus issue means obviously your share capital is going to increase and your revenue reserves are going to decrease. And since both of these are actually equity, you would have to show it in your statement of changes in equity. The fact that overall equity stays the same doesn't matter. Because there was a change within equity, you'd need to show it. Debenture interest, well, remember, debentures are liabilities, and as such, the interest is then a finance cost, and so equity is not affected at all. Number 3, the profit for the year will increase the revenue reserves, and remember, revenue reserves are part of equity, so we do like that answer. Number 4, a profit on the disposal of non-current assets is actually just going to be a normal income on the statement of income, and as such you would not show it in equity. It does indirectly affect the equity because obviously it'll affect your profit for the year, which will increase your revenue reserves, but as it is on its own, you wouldn't show an item, you wouldn't have a line item for profit on disposal of non-current assets in the statement of changes of equity. So therefore we like answers 1 and 3. So let's go and have a look at the options that are available, and we can see fortunately there is one that we like, and we will choose B as our answer. Let's now have a look at number 20. A company issued 25,000 ordinary shares of 50 cents each at a premium of 25%. They had a market value of $1.50. Now, there's actually 3 different prices here. 50 cents is your par value or your nominal value. Your premium of 25 cents means that you would have a share premium account or a capital reserve to show that amount, and that is your issue price. So it means that your issue price would be 50 cents times 1,25. In other words, it would be about 62.5 cents each is the price they would have been issued at. The market value simply refers to what they are trading for outside on the open market. And this actually doesn't affect the company at all. No transaction is happening with the company. And so therefore the company won't record this market value in their books at all. What is the value of ordinary share capital in the statement of financial position? Ordinary share capital is just the par value. In other words, this 50 cents times the 25,000, in other words, $12,500, which is why you would choose A as your answer. If the question had asked for the value of the equity, then you would have to say times 1,25 or add on a 25%. But the question is just asking for ordinary share capital, not total equity. Cambridge, June 2016, paper 1-2, question 12. Now, this is quite an interesting one, and you're going to have to think quite carefully. You might want to make little notes for yourself on the side. The directors of a company are completing the financial statements for the year ended 30th of April 2016. Note the date, this is very important. they discover that the inventory at the 1st of May 2015, in other words, the beginning of the financial year. It would be very easy for you to miss that, and if you use this as the year-end figure, you're going to get it all wrong. So do make a note that you are sitting at the end of 2016, and they found that the inventory at the beginning of the year, 2015, was overvalued by $50,000. In other words, whoever had prepared these financial statements the previous year wasn't very good, and they made a mistake and it wasn't picked up by the auditors. That doesn't necessarily mean the auditors were in on it or they intentionally covered it up. It just means that it perhaps wasn't in the sample that they checked. And it does sometimes happen where you'll find an error that needs to be corrected a year late. So how would you go about correcting this error? They want you to show what would the effect be on this year's profits and what would the effect be on the retained earnings brought forward, because basically last year's profits would also be affected, and the way that you would need to correct that is by then adjusting your retained earnings account. So let's have a look firstly at this year. If this year's opening stock is overstated by $50,000, it means we thought we started the year with more stock, which means that our cost of sales would be overstated, because remember that cost of sales, you would have added opening stock to this calculation, and it was too high. If your cost of sales is overstated, it means your profit would have been understated, which means you actually need to increase your profit for this year. If you're looking at last year's, it means that in 2015, your closing stock was overstated, which means your cost of sales must have been less than what you must have been understated. In other words, it was actually more than what you thought it was. And if cost of sales was understated, profit was overstated. So you can see that what happens is that because that 50,000 was sitting in the wrong year, it just means that your profit for the 2 years, the amount was in the wrong place. So last year's profit was overstated, and you would therefore need to decrease your retained earnings. So in other words, you need to take a profit from last year and move it to this year to be more correct. And if you look at the options that are given to you here, the one that suggests increasing this year and decreasing last year is C. And so C is the answer that you would choose. Right, moving on to question 15. This is another one where they give you a number of scenarios and you need to choose which ones you like. And again, it's very important that you look at them before you look at your ABC, and then go and find your answer there. A company's profit from operations has increased by 10% in a year. Remember, operating profit or profit from operations is your gross profit plus or minus all your other operating expenses, but it's before your interest income and expense, in other words, your investment and finance income and costs. While its gross profit has only increased by 5%. Gross profit is obviously your sales minus cost of sales. So the first thing you need to do is have a look and see what is the difference between these two. Well, at the top of your statement of income, you would have sales and cost of sales gives you your gross profit. And then below that, you would show your operating income and your operating expenses to get your operating profit. So the operating profit would sit down here somewhere, and it would then be followed by your investment income and finance costs. The question then asks, what could explain the reason for a larger increase in operating profit than in gross profit? And given the fact that we've already seen that the difference must be our operating income and operating expenses, it means that either my operating income must have been higher than normal, or my operating expenses must have been less. So we need to now go and look for some options that would suit this. A decrease in finance costs? No. Finance costs are after the operating profit and therefore do not explain this difference. That is something totally separate. Distribution costs, however, number 2, are operating expenses, and if they dropped, it would explain the reason for the operating profit being higher than you would expect. Number 3, an increase in rent received is also what we were looking for. It's an increase in the operating income, so we like answer 3. And then number 4, an increase in selling prices would simply increase sales, but sales is before the gross profit, and as such doesn't explain this change. So we need an answer that has options 2 and 3, and over there we can see we would choose C. 16. A company has 1 million ordinary shares of $1 each issued at $2.50. Here again, you can see the difference between the par value or nominal value and the issue price. And the difference between these two, that extra $1.50, would have been the premium. It also has a 5% debenture of $300,000. Remember that a debenture is actually a loan, it's part of liabilities, but 5% means you have to pay interest of 5% every year on that loan. Profit from operations for the year was $465,000. Remember, profit from operations is before finance costs, so you would also need to take this interest on the debenture into account thereafter in order to get profit for the year. The directors paid an 8% ordinary share dividend during the year, and obviously share dividends would then be paid out of the profits for the year. And the question asks, by what amount did the retained earnings increase? So we need to actually use all of this information here. If you have a look, you can see I've started with the operating profit, but then I've subtracted, I've included my interest on the debenture, otherwise known as a finance cost, which I work out by saying the $300,000 times 5% to get $15,000 as my interest cost. And that means that my profit for the year is actually $450,000. So that is the amount that would then go to appropriation to be divided between the shareholders and being kept in the business. And so now I can take into account this dividend, which is going to be my million times $1. Because if I'm referring to an 8% ordinary share, that 8% is being expressed as a percentage of my nominal or par value, or in other words, of my share capital. So I'm going to work out my share capital as $1 million times 8%, and I will then show 80,000. That will then reduce the retained earnings. So my total overall increase in retained earnings will be only 370, which is actually quite a lot. You can see that we've kept a lot more than what has actually been paid out to shareholders, which is a very healthy state of affairs for the growth of the business. We then go and have a look for an answer that gives us this as an option, and we will choose B. Question 17. A company issues 100,000 new $1 ordinary shares at a premium of 20 cents each. Which effect does this have on the statement of financial position? Well, what I'd suggest you do is look at this transaction and decide what accounts are involved, and then of those accounts, what affects our statement of financial position, or how it affects it. What is going to happen over here is, firstly, you will have 100,000 times $1 going to your ordinary share capital account, and it will increase by that 100,000. Share capital is equity, and that obviously does affect your statement of financial position. The difference between this $1 and the actual issue price of $1.20 is this premium of 20 cents, and that would increase your share premium account, and that's also equity, which also appears on the statement of financial position. Keep in mind that at the same time you would have received money, so the 120,000 that bank would have increased by also would be reflected on the statement of financial position, as that is an asset. Now, if you have a look at the answers given, it's actually quite interesting, because the first one, equity increases by the nominal value but decreases by the value of the premium. That makes no sense. Premium is increased, so A is not an option. Equity increases by the nominal value only. No, the premium is part of equity and needs to be used here too. Number C and D, instead of referring to equity, it refers to net assets, which is actually quite nice. Keep in mind that net assets is your assets less your liabilities, and this would equal your equity. But it's a lovely way of actually showing that your asset bank is increasing at the same time as your equity increasing. So C suggests that the net assets increase by the nominal value of the shares plus the premium, and that is certainly an answer that we like. Number D, we need to just check the net assets increase by the nominal value but decrease by the value of the premium. In the same way that A is wrong, it's exactly the same for the same reason. In actual fact, notice here, net assets and equity mean exactly the same things. So the fact that they've used a different term here doesn't make them different. A and D are saying exactly the same thing. Fortunately, we don't like either of them, and we would choose C as our answer. Question 18. The trial balance on the 31st of December 2015 showed the following information. Ordinary share capital $1 shares is 500,000 and retained earnings 300,000. We are then told that on the 1st of January 2016, which is basically the next day or just after these balances are given, the directors created the general reserve of $70,000, and at the same time 200,000 ordinary shares were issued. By which amount did the total reserves increase on the 1st of January? Remember, reserves is everything else in equity that is not the share capital. So we need to have a look and see what these changes will actually affect. The first part where they create the general reserve, keep in mind that this would have come from retained earnings. So your retained earnings would decrease, but your general reserve would increase. So they would cancel each other out, and there's actually no overall effect or change at all. So we won't use that $70,000. With the new share issue, the share capital itself is not a reserve, so we won't look at that figure at all, but the premium is. So we need to look at the premium amount and see what that is. The premium, remember, is the difference between the ordinary share capital amount of $1 per share and the issue price, which in this case you can see was $1.50 because you received $300,000 for 200,000 shares. So the premium was then 50 cents, and 50 cents times 200,000 is $100,000. Alternatively, you could look at it as the cash amount of $300,000 minus the amount of that would have gone to ordinary share capital, which is 200,000 times $1 each, or $200,000, leaves you with your $100,000. Let's go and look at the answers, and we can see we will then choose A as our option. Looking at Cambridge, November 2016, paper 1-2, question 18. A company had an issued share capital of 400,000 ordinary shares of $1 each. It then made a bonus issue of 1 share for every 5 held. Remember, a bonus issue means that it's usually in place of paying dividends. They give each shareholder an extra share, but it's paid out of the reserves. This was later followed by a rights issue of 1 share for every 3 held. So this means that shares were offered to the shareholders that the existing shareholders could buy, and this was then in a different ratio. It doesn't really matter what the ratios are, but it just means that there were less bonus shares issued compared to the rights issue. The other thing you've got to keep in mind is that when they made the rights issue, the bonus shares had already been issued. So what was the balance on the share capital account after these transactions? Obviously, you'll start with your beginning share capital amount, and you'll see that we don't use any premium or anything here. Fortunately, you haven't even been given any of those figures to confuse you, but it is something you can keep in mind. You're just looking at your ordinary share capital, in this case 400,000. You will then add the bonus shares. The bonus shares, at that time, there were 400,000 shares in issue, and for every 5 held, 1 new one was issued. So that means that you would say times 1/5 to get 80,000 bonus shares, or divide by 5 to find out how many bonus shares would have been issued. So that means that after the bonus share issue, there are actually 480,000 shares in issue, and that is the amount that you will use for your rights issue. So you will need to add 480,000 times 1/3, or 1/3, because for every 3 shares held, 1 is issued, and that means that 160,000 are given as a rights issue, and so that means that $640,000 will be the balance in this account at the end, and we will therefore choose D as our answer. Question 19. Which action will increase the equity of a limited company? Well, if we have a look at each of them, remember equity is basically the net assets, or assets less liabilities. So we're not going to use assets, we're not going to use the liabilities, we're looking for equity items. If we create a general reserve, as we looked at previously, it means your retained earnings will decrease and your general reserve will increase. But you see that both of these are equity, so they will actually cancel each other out and there is no effect. So A is not an option. B, issuing bonus shares. If this was a normal share issue, we would increase or credit our share capital and debit bank. But in this case, remember that bonus shares actually come out of our retained earnings. So the share capital or equity will increase, but retained earnings decreases. And since retained earnings is also an equity, as it was when we turned it into a general reserve, it means that we actually are going to cancel it out, and again, there's no effect. B, we cannot use. Number C, issuing debentures. Well, debentures are a liability, so that doesn't affect equity at all, and we would receive money and the bank would increase, but that is an asset. So yet again, the equity itself is not affected. Yes, net assets you might think is going to be affected. Well, actually no, because it cancels itself out again, just like these ones that were both in equity cancelled itself out. So D is actually the only option left. Let's hope we like it. Issuing non-redeemable preference shares. Well, in reality, it doesn't actually matter what kind of shares it is, but the fact that we issued shares that are not bonus shares means that our share account will increase, in this case, our preference share account, and our bank increases. Now have a look over here. Equity is increasing and assets are increasing on the other side. And so therefore, our net assets are increasing. In other words, equity is increasing.